Welcome to SALTovation. The SALTovation Show is a podcast series featuring the leading voices in SALT, where we talk about the issues and strategies to help you make sense of state and local tax. Hello, everyone, and welcome to another SALTovation discussion where we are joined by Brian Schwam of WTP Advisors. Brian has over 30 years of experience in international taxation and will walk us through some of the nuances of non-U.S. taxation and how it overlaps with state tax. Brian, thank you for being here today.
Thank you, Meredith. My pleasure. I'm looking forward to our conversation.
And of course, SALTovation's Judy Vorndran. Hello, Judy.
Hello, Meredith.
Brian, I want to start with you. You have carved out your career to focus on a niche area of taxation, being in the international tax arena, much like us SALT professionals. We find that not many practices outside of large firms have an international tax resource or really know where to begin when it comes to addressing anything outside of U.S. federal tax. So how did you come to focus on international tax, and then what brought you to WTP?
Great question, and hopefully an interesting answer. I like probably most of you, I started in the Big Four, where I was a generalist and I did everything for the first 2 years of my career. A few years into my career, I was asked to specialize in an area. So I chose international. I had the choice of international or state and local, and I chose international.
Thanks a lot.
Yeah, I know. It seemed a lot more like there was more to it. Is what it seemed like at the time. And the laws were different back then. And as a result, there was a lot more to it. I would maybe not say the same thing today, but at the time, that was definitely the case. And so for the next, let's say 15 years or more, I focused specifically on international tax. And international can really be broken down into outbound international tax. That's U.S. businesses that are expanding and doing business outside the U.S. And then there's also inbound, which is foreign headquartered businesses that are either investing in or expanding into the U.S. And within both of those categories, you've got your large companies, your middle market companies, and your startup companies that may be small in size. And the issues may be the same in all cases, but the magnitude of the issues may not be the same, but the issues are there. And the smaller the company gets, the more that there seems to be a lack of compliance with what needs to be going on. So when I left the Big Four, I decided to focus on the middle market and the lower end of the middle market and the mom and pop type businesses. Really, what I found out the day after I left the Big Four was that CPA firms all over the country needed somebody with my skill set, and because they didn't have anybody in house, and they couldn't afford to introduce their client to one of the Big Four or one of the national firms that had the resources. So I've been acting as a bolt-on resource or surge resource for all these firms for the last 15 years. And as a result, I can apply what I learned and what I applied in the Big Four to large companies, to these smaller companies. I can help these firms service and keep their clients and not expose them to losing the clients to a larger firm that could be more full service. And as a result, the CPA is happy. They get to keep their client. I'm happy. I've got a good stable of work, and the client's happy because they're being served by who they want to be served by.
That's kind of like us, the same thing, because there's not a lot of SALT resources at the regional firm level outside the Big Four. So it's very interesting. Your path was very similar to ours.
And my path was completely accidental because I didn't realize that would be the case until, when I left. After leaving Ernst & Young, I was at KPMG for a couple of years. And when I left there, the individual who had been the managing partner of the office I was in, he had left in the intervening time period. And The day after I left, I just shot him an email saying, "Hey, here's what I'm doing now." And he's like, "Let's have lunch. We can use you." And that was the start of like something I never even imagined would happen.
And I don't even go after that actually. So it's interesting that and that's how we know each other because we used you and I didn't even know we were using you as a white label resource with our international tax team at the former regional firm. I was the head of the national salt practice. So that's kind of funny. And then we found each other a different way. And then come to find out you had actually done some projects for some clients of mine and I didn't even know it was you. I
Uh,
thought that was pretty fascinating,
um,
actually.
yeah, it
Um,
is. And the tax world is extremely small, right? As we all know.
right.
You'd mentioned that, you've worked with or, there's the giant companies that have issues, even kind of down to the small mom and pop. So what factors cause, on this and, kind of in this question, I'll talk about kind of the inbound stuff that causes a foreign corporation having a taxable presence in the US.
Great question, and one that has many different answers depending upon the location of the foreign corporation that's beginning to do business in the US. So we have to distinguish between whether that corporation is in a country that has a tax treaty with the United States or whether it's in a non treaty country. So, an example of a non treaty country would be just about any country in South America, for example. So, if a Brazilian company is carrying on business in the US under the definition found in our tax code, then they become subject to US tax on some portion of their income. Okay? And it doesn't take a lot to be carrying on business. And so those non-treaty countries are probably more akin to the state rules because the other set of companies would be from treaty countries where we have a tax treaty. And the tax treaty has pretty standard language describing what's called a permanent establishment. And the permanent establishment is a higher threshold than carrying on business. And if a company ends up having a permanent establishment, then they become subject to federal U.S. federal tax on their U.S. source income that's related to that trade or business that's got the effectively connected income.
So then how would you say a lot of, non-US businesses are generating income from the States? Is it, online sales? Is it they're a distribution channel? They're a manufacturer? How does that kind of revenue happen?
Yeah, so it's kind of across the board. Obviously, there's more and more online, e-commerce activity going on, where foreign companies could be selling directly to U.S. consumers, individuals, or they could be selling to U.S.-based companies who may be reselling the product or using the product in their own business. And again, that's one channel. Most of the time, if a foreign manufacturing company is they may end up setting up a subsidiary in the US to act as a distributor of their product. They don't have to do that. Sometimes they do it directly from their own, foreign entity. And they don't have, they're not storing inventory. They're just shipping in. They don't think they really have anything here. They don't need anything here. That's one way that they generate revenue in the U.S. Like I said, the other way is to have their own wholly owned subsidiary. They could sell through independent dealers and distributors. I think we have some clients in common that have been doing that, selling through dealers. That's pretty common. Then there's the business to consumer line, which may go through a dealer or it may not. It may go like just right off the internet directly to customers.
Right, somehow off a ship at the port on into the so, I think about years ago when remember Toyota had to put plants here and Honda put plants here because they were foreign car manufacturers and we were buy America, right? Detroit was blowing up. Like, can you speak to that kind of those issues? Like, there was a choice by some foreign entities to choose to build in America. Was it a political thing? So they would not lose traction of getting customers in the U.S. market, and that's why they put plants here.
I think there was an element of politics associated with that, yes,
Okay.
because there was a time, and I don't recall exactly the point in time, but it was like, oh, we're sending these dollars to Germany or to Japan or these other auto manufacturers. And so if they had a plant, like if there was like Honda Motor Company of America, now you're not buying a car from Honda Japan, you're buying it from Honda US. And so people could feel better about, oh, I'm buying something that was really made in America. Well, was it really made in the US? Parts may have been shipped in and it was assembled in the US, but it wasn't necessarily fully engineered and manufactured in the US. But enough of it where people, I think, felt better about it than they did when it was just being imported as a final car from Japan. Tariffs may have had something to do with that as well. I'm not sure, but sometimes when you import parts, the customs duty on those parts is completely different than when you import a finished automobile.
And the import export system kind of covers some of the duties similar to like a sales tax. It's a duty on the item being the value of the item coming in. And we have to incorporate that into the cost of the goods sold, right? When we end up buying it as an end user. So
Yes.
it's sort of like a sales tax or a VAT, a duty, right? But
Well,
that's,
yeah, but a duty is also kind of like a trade barrier,
yes.
where they're trying to protect the U.S. business. So you can't you can't buy a car from Japan because it's going to have a 20% duty added onto it, so it makes it not non-competitive in the market in terms of price.
Okay. And then is that you'll normally handled like at the border? It's not like I'm paying the duties as I don't how does that work in terms of how
Well,
people pay?
when the importer imports the goods into the
Mhm.
U.S., whoever that is, it's not going to be a person that's buying the car. It's going to be probably either Honda Motor Company of Japan or some dealer in the U.S. One of the Probably it's going to be the former. They have to pay the duty to the government to bring it into the country.
And it's interesting because you don't have a resale exemption in that instance. Even though the end user is me, I'm gonna ultimately buy the car, but it's the dealer that pays the duty. And then it ultimately gets wrapped into the purchase price that I pay, and then I have pay a sales tax on that. So it
Right,
really does ratchet up. It's basically tax on tax.
right, and it's to protect U.S. business, and most of these companies that have set up U.S. facilities, they're not in Detroit, they're not in the north, they're not in the Rust Belt, they're down south where there's no unions and labor is cheaper, and they were able to do it. There's a large Mercedes plant in Alabama. There's a number of large auto investments around the Atlanta area. So it's all in that part of the country. And so there may have been a labor savings. Labor. There's a lot of labor-related taxes in a lot of foreign countries that we don't have here.
Well, and then I'm just thinking as well, like if you think about all this, I mean, business is business, but business gets affected by taxes. And then taxes cause business to repurpose itself or whatever, restructure, revise in order to streamline operations or cut costs in order to minimize the tax impact. So there's a lot of things you have to think about if you're a multinational business.
Exactly right, Judy.
And excise taxes and all that, they're high. I mean, they could be 20% or 30%, right? So you're not talking like 8%, 1%. It's a significant cost to
hmm
manage.
but I will guess, and this is a guess because I don't know for a fact, that these auto companies set up these plants in the U.S. to avoid customs.
Yeah, I bet.
Because years ago I had a client that made small engines and outboard motors for boats, and if they imported those engines, the duty was relatively high. If they imported the parts and assembled the parts and then sold the engine, they avoided the duties completely.
So it's a bit of a rate arbitrage. Interesting.
Yeah, and well, it's protectionism.
Sure.
We're all familiar with Harley Davidson, right?
Yes.
Made in America
Yes.
bike. Well, the ones that they sell in Brazil are made in Brazil because if they try to import a finished motorcycle into Brazil, there'd be some ridiculous duty added onto the top of it, the value, make it completely non-saleable to a customer. But if they import the parts into Brazil and assemble them in Brazil, thus creating jobs in Brazil for people that need work, then the duties don't exist. So they work in a lot of different ways to either promote local business or to protect other existing businesses. But that's kind of the nature of that whole, you know, duty and trade war.
Well, and then this whole concept of who we have treaties with and who we don't have treaties with, right? Where we play nice in the sandbox with some other countries and we don't play so nice with others. So that is a very interesting issue that you brought up at the very beginning, which is, do we have a treaty or not? First question to look at, because then there's beneficial tax treatment if there is a trade relationship with another country. And I think that kind of that perception with countries that have treaties kind of spins down all the way to federal tax and state and local tax. They misapprehend that the treaties are not universal, right? They're just federal to federal government, not state government, and so forth. I think there's some misnomers of that. Oh, we have a treaty, therefore everything's exempt, or the U.S. federal government doesn't care about it. And of course, that ends up being an issue for me. Is our state
Right.
governments do, because we don't always follow the treaty.
Right. So it's interesting because the non-treaty country, I think the federal and state treatment is going to be the same.
Yes. Yes.
So what's bad for federal is kind of easier for state
Yeah.
because federal and state are married up.
Yes.
And if there's a treaty which is good for federal and allows the foreign company to avoid potentially paying U.S. tax, federal tax, now you've got a mismatch between federal and state,
Correct.
which creates, probably what I would call a nightmare scenario for companies.
Well, and I think it's misknown, especially in the small and medium business market, in the regional firm level, especially. They have no idea that those treaty exemptions exist or don't exist, and they automatically uh, 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 put them towards the states. And there's a misrepresentation by the practitioner who just doesn't understand the state tax consequences at the medium tier level.
Well, and much to like Public Law 86272, a treaty is only going to apply to income tax. So we still have, you sell in, and especially now with Wayfair having gone in, over 2 years ago, if you are a non-US company, you sell more than, 100,000 or 200 things into a certain state, you now have, the state doesn't care where you sold from under Wayfair. You have a sales tax, and treaties just don't exist regardless.
Good point. No, they only extend to income tax.
And we're just such a great market with 335 million Americans. I mean, we buy a lot of stuff. So, and we like to buy it reasonably priced, or should I say cheaper, which is why you have a lot of import issues where there's some confusion amongst what the compliance duties are when you're importing out of country into country.
Well, and it's funny, there's like a boutique in Denver that I really like going to. And I was, I buy like this certain brand, and I decided to go directly to this website once just to see what else they had. So I bought some stuff, and they didn't have sales tax on my invoice. So of course, like I reached out to them. I was like, oh, hey, by the way, you should be charging me sales tax, blah, 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 blah. Went into this like, not diatribe, because, let's be honest, I'm going to like a customer service rep. She's like, oh, well, thank you. That's really helpful. Let me see what I can find out. And she's like, oh, we're a Canadian company, so that doesn't matter. I was like, well, da, 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 da. And she's like, oh, okay, I'll pass that on. And then they're just probably like,
Hopefully
yeah,
they will
whatever.
figure it out.
Right. But coincidentally enough, I bought from them recently again, and there was still no sales tax. So I should be like, hey, by the way,
Maybe you're their only U.S. customer.
maybe me and the boutique that I buy it from.
Yeah, yeah, that's a huge issue that I find to be, a lot of Canadians do perceive like the states aren't going to catch them. And I think that's going to really change next year.
I think a lot of Americans perceive that the states aren't going to catch them.
Yes.
Let's just not isolate that to like non-US based businesses. That's a good card. We don't want to make our friends to the north mad, but yes, I think that's a very good
But I think that's something that we share in common because like I just said, a lot of people that live in this country don't think the states are going to catch them. Well, in the the international section of the Internal Revenue Code, CPAs that I often deal with, they don't think of those as rules, but rather as guidelines because they don't think the IRS is going to catch anybody. So it's the same. We kind of fight the same battle, the uphill battle, like, oh, this isn't real. Oh, transfer pricing. Oh, we don't have to really do transfer pricing. Um, we don't have to let the IRS catch us.
Well, so then what happens? What are the penalties if you get caught? And like, what do you have to do that you're going to get caught on? So, like, what are the rules you have to follow? And if you don't follow the rules, what are the consequences if you get caught?
Sure. Well, the rules are there's thousands of pages of regulations on what the rules are, so I won't go into that. But the penalties can be, either 20% of the tax that you didn't pay that you should have paid. If it's a certain level, it goes up to 40% of the underpayment at another level. And the way you avoid all that penalty exposure is to simply have a transfer pricing study when you file your return. If you have that study done, the IRS can still come in and adjust your transfer pricing, but there'll be no penalties because you did attempt to look at it. So we had a client that said, "Oh, look, we did a transfer pricing study like 6 years ago. We were never audited. We're not." Then they stopped doing it, and then they got audited. And so instead of like paying us a fee of, let's say, $10,000 to do a study, they paid us $90,000 to fight with the IRS and get the IRS adjustments waived.
And it was a huge amount of money. Assuming because if it's they're going to disallow all those deductions for the cost if you don't have a valid
Right. Or
study.
they were going to attribute income to the US by imputing a royalty on the foreign sub that it should have paid the US, all these things that if they would have done a study, the IRS wouldn't have that chalkboard to just draw up and do whatever it wants.
Right. One of the first things Judy and I kind of did together is we wrote an article that was like, it's expensive to be non-compliant. Like, but like if you can get ahead of it, I know you don't want to pay us 20 grand now, but you're going to pay us 80 grand later. Plus you're going to pay someone else 100 grand. So,
But then I think
um,
that's what works, honestly. Like nobody wants to pay to get in front of it, I find sometimes. Like it's expensive. They're starting up. They don't want to think about it. They got business to run. And I think that's nothing compared to what you could pay if you get it wrong. And I find it interesting. I make more money on the people who did it wrong because I got to remediate it everywhere, right? And I've got to kind of put a plan in place and it costs a lot of money to remediate. And but it sort of feels like the culture. And my husband, we have a new puppy and the dog trainer, which we started before COVID and haven't continued because it got canceled, um, said you have to reinforce an animal with positive reinforcement, right? Not negative reinforcement. You want to make them, but we have the system of punitive reinforcement as opposed to you should just file your taxes and that's the law. But there is a culture in America and maybe elsewhere as well that is not about voluntary compliance. And I think that's a fascinating cultural difference I have seen. Although some countries like the UK are known to be very compliant. What do you what do you make of that? Like the is that why we don't have treaties with some of them because they're not very compliant versus others that are more willful
Mm,
to be compliant?
no, I don't believe that's the reason why. And I'll give you an example. In most Latin countries, including Mexico, we have a treaty with. The tax advisors are almost like agents of the tax authority.
Okay.
Like they have to sign, like there's a box on a Mexican tax return. They have to check a box that says there's a transfer pricing study been done. Check yes or no. And I've reviewed it. Check yes or no.
Ooh.
So we don't have any. We're not agents of the tax authorities here at all. But that's often, and certainly in Latin America, that's often the case. Like they're like, oh, I can't take that position because the hacienda, which is the Mexican tax authority, they'll be upset with me. I can't do that. So got no relation to whether we have a treaty or not. It's just the culture. And I think, well, the other thing that I've seen over the last 10 years is, well, and I'm dating myself, when I started in public accounting, if you were the auditor, you did the tax,
Yes.
everything. And, after Sarbanes-Oxley, whenever that was, like 2004, I believe, now that's often split. if I'm the auditor, I don't do any tax work. Somebody else does the tax work. And then the auditor says, well, I have to review what they did because I have to sign your audit report. And so client pays, extra fees to have it be done by separate
Yes.
parties.
That's funny. That's kind of how our firm got started was provision work. So because of Sarbanes-Oxley, we were really good at provisions and we were that intermediary between the big four and our clients because they couldn't do both. So they needed us to do that
Right.
middle part. And we still do.
No, I was going to just say back to that example about pay me now or pay me later. And I'm a little bit older maybe, but when I was a kid, there was a Fram oil filter commercial, and I
I
don't know
remember Fram.
if either of
Yes.
you. And there's the guy, the mechanic has got his head in the engine, and the guy whose car it is like, oh well, is there a problem? And he holds up the oil filter and says, you can pay me now and buy this Fram oil filter, or pay me later.
This is a main bearing job, about $200. And this is a Fram oil filter. It's about $4. Now, if the guy who owns this car had put $4 into one of these when he had his oil changed, chances are he wouldn't be putting $200 into one of these. Well, choice is yours. You can pay me now or pay me later.
Sometimes people would rather pay for the new engine down the road because they didn't want to worry about it.
Yeah, no, and that's what happens. I like that example though, because that's real. And you know the differential in those costs. So we can use that. That's a good one. I'm gonna put that feather in my cap and use that on my next argument for people to do it now.
I was like, I'm sure if you spend some time on the internet searching, you could probably find the commercial.
Yeah.
I can see it running in my head actually, which is kind of
That's
strange.
really
But
funny. I remember though that brand.
Well, so then on the flip side, like and kind of roping back in like the penalty stuff, as as like a US based business with foreign operations, there are certain things that you have to do as a US business with your foreign stuff to like make sure you're telling the government that you're doing things correctly. And then
hmm
also there are what I know there's oftentimes, people have heard like this $10,000 penalty for just
Yes.
not filing a form,
Yes.
and it's per form per year. So what's kind of, the outbound.
Yeah, so there are a number of forms that whether it's a corporation with a foreign subsidiary, a corporation with a foreign disregarded entity, or an individual that's a beneficiary of a foreign trust, or
Bank account.
bank accounts. There's many different things. It's all about transparency. The IRS wants to know everything that you have everywhere, regardless. And the forms are getting worse and more complex all the time. I just noticed the other day that there's now something called a K2 and a K3 that's going to be effective starting in 2020 for 2021 tax years. Combined, they're 42 pages.
Good Lord.
They're attachments to a Schedule K1 for all the international stuff that has to be reported to a partner of
Like a partner,
in a U, like a U.S.
like a foreign
partner,
partner. Oh, a
like
US partner needs
a
all this
U.S.
stuff too?
partner. Yes,
Oh, good
yeah,
Lord.
yeah. So I mean, it's getting out of control, but the information is necessary. Like for example, like all the guilty information that relates to that partner would be listed on that Schedule K2, so that their tax advisor can do what they need to do. There's a
Right.
lot of there's a lack of uniformity as to how partnerships and S corporations are reporting all that stuff to their
Well, my
partners and
perception of
shareholders.
that is it's sloppy. And it's done a lot by the regional firms where they don't have a strong multi-state from my perspective. So you don't even know what the apportionment factor should be when you get a partnership K1. I mean, you don't really know what to do with it. So then you don't do anything with it, which means that partnership income is not being properly reported across the nation where it's earned to the
It's not that
partners.
you don't know what to do with it. It's like, because we have some clients that are investors in partnerships and we'll get K1s. It's like, and we'll push back and ask for apportionment. They're like, well, we're a partner in another partnership and we didn't get their apportionment. So we didn't flow it through. And so it's like, well, I'm, I'm going to file a return. I'm going to do the best I can, but I'm kind of backing into this so that I can at least be the most compliant I can be. But it's kind of like garbage in, garbage out. But so that's good to know though for 2021. What you're telling me is we need to start charging our partnerships more more
Because
money
more work's going to be
because
needed.
there's going to be all this reporting stuff similar to what like the 199A that came out of like tax reform and like the I mean I play a Fed person on TV and not very well. Um but yeah, so just, there's burdens on us. And did any of that come out of like tax reform or is that just an evolution of just businesses in general?
It's mostly due to the tax reform and the regulations that followed that basically said if a partnership or an S corp owns a CFC, they're treated as aggregates, and you look through them to the people or whoever owns those partnerships and S corps. They're considered the shareholders of the CFC, and so you have to flow all that information through to them so they can do what they need to do with the subpart F or the guilty or the foreign tax information that they might need to claim a foreign tax credit or something like that. So it's I mean, yes, it's a lot of pages, but I think the information is necessary. And right now it's going in white paper statements. They're different depending on who you get it
Yep.
from, and it may be incomplete. I just talked to somebody the other day. He's like, "Well, here's what we got from the partnership." I said, "Well, did you get this, 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 and this?" No, we didn't get that.
So
So,
now if there's
I
And it's
didn't think
also
they
September 12th and you're not going to, so
right,
have fun.
exactly. Yeah, and his partner in the partnership was an S corp who had to put all that on the S corp return or K1s for the S corp shareholders. And then there's confusion about, oh, does this stuff flow through the actual partnership or S corp return? And the answer is it doesn't. It like hopscotches around that return and goes directly to the people who are the shareholders and the partners. It's so there's no basis adjustments for any of that foreign income or anything that's flowing through, unless of course the foreign stuff is check the box, then it's a whole different regime altogether. But the penalties, and I'll get back to the penalties. The penalties can be severe. They can add up in a hurry. I had a client last year that was looking at $2.4 million of penalties.
We're just
They
not
had
filing a form.
well, he was dual citizen, US and another country. He left the US 5 years previously and was advised he didn't have to file a US return anymore. And so he had, three CFCs, foreign bank accounts galore. Uh, and the some of the penalties are a percentage of the value of those accounts if he didn't file certain forms. So, I mean, it added up to like $2.4 million. And so we had to go into one of the programs that are available to abate penalties. So one of them is the streamlined compliance filing. If you go back and file 3 years and pay interest and tax, they'll waive the penalties. Or if you have a situation where you don't have any unreported income, but you didn't file these forms for whatever reason, as long as it wasn't willful, then you can go back 6 years and all the penalties will be waived forever. But if you don't do anything, which is always one of the options, the statutes never run, the penalties never go away, and they just keep adding up. And then when do you start being compliant? As soon as you're compliant once, it kind of alerts the IRS that you should have been compliant all along. So that's why these programs are important. And we like to have our clients use them to kind of, get clean, if you will.
So they're kind of the IRS equivalent of a voluntary disclosure agreement with states where, you come forward and say, "Hey, whoopsies, my bad. Can I fix this?" And there's some benefit to doing that.
Yeah, it's similar to that. Only it's not an agreement per se. It's just sort of like, yeah, if you do it, we'll accept it.
And then no penalties?
No penalties.
Ooh. If they accept it though. And is it anonymous or is it full disclosure?
It's not anonymous.
Okay. So you're
What you
in.
do is whatever you didn't file that you should have filed, you attach a reasonable cause statement
Okay.
as to why you didn't file it. You attach that to an amended federal tax return, and you send it into a particular location. I think it's Austin, Texas. And I've never heard a client even get a response from doing that, but they don't they don't have to worry about the
But it's like
penalties
no
anymore.
note, like no response is your response that you're good, kind of, sort of,
No,
maybe.
nothing like that. Nothing happens.
Huh.
You just do it so that you're in and you can comply. And then the
Yes.
penalties
But
will be
if you're
abated.
right, but if you're contacted by the IRS for audit, you can't do that program. So it's important to do it before you get audited.
Right. Yes, we have that same situation with the voluntary disclosure. Although a couple states do allow you to to be caught. With Michigan, speaking of which, if they catch you, they'll automatically let you participate in the BDA program, which is kind of nice of them, actually. But that's not
Or at
common.
least they have in the past. We've found very, the states are constantly
Well, I was
changing
going
their
to say
administrative
it's
policy.
their
Like,
administrative rule. They can do whatever the heck they want. So they can change their mind next week for all we know. So yeah.
Yeah.
right.
So the other area where companies I find aren't necessarily compliant is if they're in a treaty country, they have some activity going on in the US. It doesn't rise to the level of a permanent establishment under the treaty. Maybe they don't have a fixed office or place of business. They don't have any people on the ground that are signing contracts on a regular and habitual basis to bind the company. And they're not like involved in an installation project of any length of time. And that would pretty much say, unless you're from Canada, those are the factors that you would look at to determine if you have a permanent establishment. But even if you don't have one, you still have to file a return and claim the treaty benefits.
Right.
And that I'm sure is not going on a vast majority of the time.
Correct. Well, we have that same issue with Public Law 6272. What, 50 states, 40 something have income tax, base tax. And what we find is a lot of people think, oh, you have PL 6272 because you sell a thing, therefore you're exempted under this federal law, but you have to affirmatively file something in some states to assert that position. Otherwise, you don't have it. So you don't toll your statute. So I think there's a lot of misperception out there that you don't have to file anything when nothing is due, but something is due to assert that you don't owe any money, basically, is the way I argue it. But there is a misperception out there about the complexities of that. And then a lot of people just don't do it. Their advisors tell them they don't have to do it. So then the poor business owner is counting on their advisor and they didn't know that particular, proclivity.
Well, right. And, because circling back, if we take this full circle, why, Judy, you and I have a job and have been, successful outside of the big four. Same with Brian, is that smaller CPA firms outside the large firms don't have, resources and experts like us. And so, kind of in closing with that, Brian, what is there, maybe one thing that we didn't talk about that you think is, the most important thing for people to know about what you do?
That's a really interesting question. One I hadn't thought about. But I think what's most important is it's to their benefit is that if someone is utilizing WTP Advisors for international tax services, they're going to get big four quality international tax advice and transfer pricing advice at a fraction of the cost. But it's going to keep them out of trouble. And staying out of trouble is invaluable, in my opinion. And so, we're in the business of keeping people out of trouble. We also are in the business of helping people, optimize and maximize their opportunities. And I think if a business isn't getting the proper advice, it's like walking through a minefield. And we try to help people avoid the landmines.
Right. That's awesome. Well, Brian, thank you today for your time and enlightening us and kind of being in a weird niche with us when it comes to tax. And so we really appreciate it. And Judy, again, thank you for being here. And I think that's it. So we will, catch you next time. So thank you again for joining the SALTovation podcast, and we'll talk to you later.
Fantastic. Thanks for having me.
This podcast is for educational purposes only and is not intended, nor should it be relied upon as legal, tax, accounting, or investment advice. You should consult with a competent professional to discuss specifics of your situation and the applicability of the information presented.